Let's dive deeper into the move in yields. The two-year yield hitting a 15-year high earlier today, only falling back slightly to end the session. But the Chartmaster says we may have already hit our peak. Let's bring in Carter Worth of Worth Charting. Carter, what are you looking at?
Well, yields. But before we look at it, and I've just got one chart. There's a lot of synchronized things going on, as we know, and it's dollar, it's yen, and it's yields. And here you see on the screen a chart, a two-year chart, yields having advanced from 70 basis points to a bit over 4. But those lines, they're not sort of fixed or manipulated. Those are two parallel lines drawn mathematically by a computer, and yields in every instance when we got to the top or the bottom of that band have reacted. Now, as a rule of thumb, when you get to the top of a well-defined channel, more often than not, you either back away or walk along and continue higher. But very rarely do you just blow right through. And so we're at a difficult level, and I think ultimately rates will go lower, just as we're seeing the dollar go lower.
Does this give air cover to higher valuation stocks or the markets in general, Carter?
Yes, I think it's the opposite. I know that's consensus, and there's nothing wrong with consensus. Sometimes that's the point of it. It's consensus, and it works. But lower yields, lower dollar, and I'm in the camp, not therefore a concomitant move higher in stocks, but lower stocks as well. Because at this point, if I'm completely wrong and yields go higher and higher and higher, not good for stocks. Or the opposite, yields do start going lower, it means something is wrong, and that's not good for equities.
All right, Carter, thank you. We'll see you in a few minutes on options action. It's a lose-lose situation, according to the Chartmaster guy. What's your take?
Yeah, I think in the short term, if yields were to go lower, the knee-jerk is going to be equities higher until people figure out the reason why yields are going lower is because the economy is slowing down. So I think he is 100% right. I think the worst thing for the market here are yields continue to grind higher. I think the likely scenario, just my opinion, 2 years is going to stay sticky, and 10-year might sort of fall out of bed here. And you might see 2s, 10s extend out to anywhere between 75 basis points and 1% inversion, which I don't think is good under any set of circumstances.
I mean, has 1% ever happened before? I'm not really sure. Jeff?
Yeah, I don't think we've gotten that much inverted, but I tend to agree, and I've been way early on this, so I'm the first to admit that. But I do think that we're a lot closer to the top in long-term yields than maybe a lot of people think. And I went back and looked over the past 8 recessions. The 10-year has peaked an average of 5 months prior to the recession. It peaked once after the recession, and that was in the mid-1970s. So if history is any guide, we are probably close to that peak in long-term yields. I agree with Guy. Given what I just said about the Fed, they have much more influence on the shorter end of the yield curve, so that continues to prop up that part of the maturity structure. But ultimately, you're going to see these longer-term yields fall in sympathy with slower economic growth. So, I mean, I think that just thinking about the bond market for a second, we're talking to clients about looking at those bond portfolios and saying, is now the time to look out further in the maturity structure, lock in those yields, and reduce the risk structure of your portfolio while increasing the income? And it's just something you haven't been able to do for a very long time, and now might be that time.
So Carter just said it's consensus view that yields are going higher, and the consensus on this desk is that the 10-year yield's going lower, because I am 100% in that camp. I think the 10-year yield tops out this year in 2022, and I do think that that is a great trade. I've been doing it through the GOVT. Guys have been talking about the TLT. I just think it's a really good contrarian trade, depending upon how you're thinking about it.
But I'll take the other side of it. And I'll say I don't think we're going to 5 or 6 anytime soon, but I will say, as I said yesterday, 2% inflation target is folly. No way. And I also look at QT. I look at $400 billion that's already come off in terms of QT. We have a lot more to go. We have a lot more refunding that the Fed has to do. We have a lot fewer foreign central banks. They're not running for the door, but they're not buying the same amount of treasuries. I also just look at inflation that will remain sticky, and where we have been over 4 decades of secular deflationary trends that are not happening. Onshoring is inflationary. When you start to do things in the energy sector, it's inflationary. When baby boomers are bidding up the housing market, even despite mortgage rates, that's inflationary. When healthcare costs go up, that's inflationary. That's the 10-year part of the curve. Really quickly, though, I will say the stuff that I was doing this week that I think there is more to do, and it's not jump in with 2 feet, but gold is rallying. And if the dollar's starting to give some ground, gold has performed like such a pig, and it actually should be absolutely the environment if the dollar's giving ground. Buying EM has outperformed, and we talked to China. We're blue in the face, and we probably put a bottom in the China market by talking about China being uninvestable a few days ago. EM's outperformed the S&P by almost 9% this week. So I was buying some EM, was buying even some casinos, and even buying some Macau casinos, because I think this China news this week, at some point they're going back to work. I don't know when it's going to be, but these things are trading at 2/3 below their EBITDA levels.
When you say gold has been trading like a pig, that's a negative, right?
Yes,
just
it is.
Clarify,
yeah,
because there are some people who love pigs out there.
I love
so
bacon. I love bacon.
I have to be careful that I malign the pig. I'm sorry.